The intention of this workshop is to exorcise that fear of risk from the minds of investors across all age groups. Although I do understand that at the age of 60 or at the age of 65 or at the age of 70, we cannot expect an individual to take a risk. Still, he can also make money by doing things the way he should so that the risk is minimized and the return is maximized. That's all about investing. The simple art of investing has one very fundamental rule, that is minimize your risk, maximize your return. So how do you go about this? Before I get into that, again, I said 90% of the people have invested in bank deposits, and there's a 9% group in mutual funds and about less than 1% in equity. Let us look at the magnitude. India today is on the verge of breaking out into the big league. We are already a 2.7 trillion economy with 30% of the GDP in domestic savings. A 2.7 trillion economy with 30% of the GDP in domestic savings. My arithmetic says that it is about 810 billion. 90% of this 810 billion is still in bank deposits. And so what does a bank deposit do to you? I invest, let us say, 1 lakh in fixed deposit. It gives me 8%. That is today even less than 8%. But let me assume that it is 8%. At the end of the first year, it's 1,08,000. And if I have invested in the cumulative form on 1,08,000, again I will get 8% and so on. But it takes, at the rate of 8%, it takes a long time for the money even to double. Forget everything else. For the money to double from 1 lakh to 2 lakhs is going to take a long period of time. If you have a calculator and if you want to compound 1 lakh at 8% to reach 2 lakhs, you will find out n, which is the number of years. Let's assume that instead of putting the money in a bank deposit, you put the same money in, say, a mutual fund instrument. It may not take that long, but the returns are generally between 15 to 18%. If you are lucky, you will invest in a fund that gives you 22%, but it's also likely that you will invest in a fund which will result in erosion of value instead of creation of value, because they themselves claim that mutual fund investments are subject to market risk, and maybe we did not read the offer document carefully before we made the investment. I have my own experience in this. 2007, when the markets were peaking, I put my money in Sundaram BNP Paribas, a mutual fund instrument which was investing in global opportunities. A lot of hope, because Sundaram with BNP Paribas, and it's a mutual fund that was investing in global opportunities. I was very excited. I put 20,000 rupees in that fund. Unfortunately for me, these people had all invested money in Lehman Properties. We know what happened to them in 2008. In September 2008, Lehman Brothers went down the drain, and so did my investment. It took 4 years for me to realize my own 20,000 rupees. Forget any return on that. Just for me to recover my capital, it took 4 years. Sometimes these things do happen. But is 4 years a short term or a long term? 4 years is reasonably long term. But instead of putting the money in mutual funds, if I had put the money in some other instrument, not as a lump sum, but as an amount spread out over a period of time, maybe I would have made a lot of money. We'll talk about this history at a later point in time. So that is the way it happened. So if out of the 800 billion that I talked to you about, even if 10% moves away from the bank deposits, which is 81 billion, and if it comes into the Indian stock markets, just because people have become financially literate and people have become more knowledgeable about the benefits of investing in equity. We would never be worried about foreign institutional investors. We don't need them also. Ramachandran of JP Morgan used to repeatedly say during the year 2008, 9, 10, I used to listen to his interviews in CNBC TV 18 regularly. He used to say that if 10% of the money from bank deposits move away from there and find their way into equity markets, we don't have to really worry about what foreign portfolio investors did. They'll be insignificant. Their role in India would be insignificant. Sometimes they act as triggers. The moment foreign portfolio investors sell, they trigger a panic. But that was long time ago. Now it doesn't happen because the moment they sell, the domestic institutional investors in India, they buy. So if a foreign portfolio investor or if a foreign institutional investor sells 30,000 stock shares in a company, there is always about 3-4 domestic institutional investors here who are ready to lap it up. They buy, they kind of cushion the fall, and so even today there is not much of an impact, although sometimes they do act as triggers. They trigger the market. Sometimes they create panic, sometimes they create a lot of hope. So this herd mentality is particularly among retail investors. So what is a herd mentality? The retail investors would want to follow the markets based on some of the cues that are happening, and they react to news. The intriguing feature of this is that investors have a tendency to react more vigorously to bad news than to good news. If there is a good news about something, markets go up by 10%. At the best, market would go up by 10%. But if there's a bad news, market would be pounded and it will come down by 20% over a period of time. Of course, it doesn't happen on the same day because there are circuit breakers. If the markets are steeply falling, the indices, that is the exchanges, would clamp down and stop trading by applying the circuit breaker, and there will be no trading for some time before people recover from the shock and come back. But sometimes even after the circuit breaker, the markets will still be going down and then again they close. There's a big story about this which I will share during the later part of my presentation. So, as I said, if the money from the bank deposits can move to the equity markets, it would be a great favor not only to the economy, it would also be a great favor to the individuals themselves, the retail investors. I have nothing to say about traders because these are people who have decidedly taken the stock markets as instruments of speculation. There is nothing that I can tell them. I'm not also going to talk about people who do this day trading. That is retail investors doing day trading. If they have the knowledge and if they have the courage and if they think that the beginner's luck will continue, let them go there. My target audience here and for the rest of my life as I go about this job, my endeavor is to help a handful of people. It may be 10, 15 to begin with, maybe 20, maybe 30. I don't know what will happen to the future, but if I can make a difference to the life of a select group of about 30, 35 people and tell them how they should go about this job and make money, I'd have served the purpose. This is the first of the series of sessions that I am planning, and just so that I can filter the people who are really keen on stock markets, I put a tag of 500 rupees. I now know who are interested. I'll stick to this group. If I had said free, I would have probably had more than about 100 people logging in, and I know what will happen. After the initial euphoria, they would all go away, and I would still be left with about 30. Instead, it is easier for me to focus on a handful of people and continue with this job of helping them create wealth. I'm not going to create wealth for them. They are going to make wealth for themselves. I'm only going to help them. To begin with, I'll handhold them for about 2-3 years, and after that, every one of them will become experts. They need us only in the beginning. After that, they will come and tell me how I should shape my future investment advice. They would share their own experience. That is what will happen. So, with that preamble, which fairly went a long way, I would like to talk about the Indian stock markets yesterday, today, tomorrow. So, the Indian stock markets yesterday, today, tomorrow. What happened? 1979, 1st April. I was still in my final year post graduation, waiting for the exams, and the Sensex for the first time as an index was constructed. The S&P 5, the Sensex that we are talking about, they took the top 30 trading stocks in Bombay Stock Exchange and constructed this index called Sensex. I'll tell you how it operates in very simple terms so that you understand this easily. How do they construct the index? Take the top 30 trading stocks, which is what they did here. The broad-based Nifty came later, we'll talk about it. The Sensex was constructed by taking the top 30 trading stocks on that day, aggregated the market capitalization of all these 30 stocks. So, market capitalization is nothing but the free float shares that were floating around in the market multiplied by the price as it closed on that particular day. It closed on 1st April 1979 at a particular price. For each stock, it closed at a particular price. This price was multiplied by the free floating number of shares. For example, the promoter stake is never available for sale in the market. They keep it to themselves. It is a controlling interest, and they are not supposed to trade also, because they have information that the others don't have, so they cannot come to the market. They cannot come and trade in the market. So the rest of it, the non-promoter stake that is floating around in the market, multiplied by the closing price per equity share. You do that, you arrive at market capitalization. You take the market capitalization of all the 30 stocks, and let me assume, for example, that is 5,000 crores. I'm just making a simple assumption that the aggregate of market capitalization of the 30 stocks that closed on 1st April 1979 to be 5,000 crores, and that is taken as 100, an index number. If you are students of statistics, you will know what is an index number. An index number is constructed by taking a fixed base. Sometimes, of course, they do chain base also, but in this case, it's a fixed base index number where they take the aggregate of prices on a given day and take it as the denominator. Here, 5,000 crores is the denominator, which is equal to 100. If from this 5,000 crores, if the market capitalization had gone up to, let us take 3,60,000 crores. From 5,000 crores, if the market capitalization has gone up to 3,60,000 crores, the Sensex would be 3,60,000 divided by 5,000 into 3,60,000 divided by 5,000 into 100. 72 into 100, 7,200 points. That is the way they compute the index. So this index was constructed on 1st April 1979 as equal to 100. Within a period of 6 months, it went to 600. Because there was a lot of euphoria in the markets that time. A lot of people were buying into the markets. They were investing in equity. Of course, although compared to the total population and the total number of people who deposited money in banks, even those days, this was nothing. But still, there was a lot of enthusiasm, and so the markets went up to 600. Immediately, somebody triggered a panic. He said, "Oh, the Sensex has gone to 600 rupees. This is the best, and we are not going to go up any further." The moment he said that, there was a selling trigger. All the people wanted to book profits. Within a period of 2 months, the Sensex from 600 crashed to 240 points. All this happened in 1979. And after that, steadily things have been going up, although there were a lot of bad times in the markets. The market was punctured by a lot of bad things that were happening. For example, the assassination of Indira Gandhi in 1983 and the coming to power of Rajiv Gandhi in 1984 through union election. He dissolved the Lok Sabha a year in advance and called for elections, and they came back to power with a thumping majority, more than two-thirds. They rode on the sympathy wave of Mrs. Gandhi's assassination, and the markets went up. Exactly 2 years later, there was a difference of opinion between Mr. Rajiv Gandhi, the Prime Minister, and his Finance Minister, Mr. VP Singh. VP Singh resigned from the cabinet and he started accusing the Prime Minister about corruption. The markets crashed again. 1989, elections were conducted. There was a fractured mandate. Nobody got majority. VP Singh came to power with the support of Bharatiya Janata Party. It did not last for 10 months. His government collapsed. The markets crashed again. Another 6 or 8 months, Chandrasekhar was the Prime Minister, this time supported by Congress. Again, Congress withdrew support. 1991, his government collapsed. Elections were called up. This time, the mandate was mixed. There are two phases of election. One before the 21st of May, 1991, and the other one was after 21st of May. Why am I talking about 21st of May? That was the day that the misfortune of Rajiv Gandhi's assassination hit the nation. In Sriperumbudur, he was killed or assassinated by a group of extremists. And so the election results before 21st May 1991, that is the states that went to poll before 21st May 1991, they were all in favor of the opposition. But after the assassination, the elections carried out in the other states all went in favor of Congress. Although Congress could not muster a majority, they could still come to power. Narasimha Rao became the Prime Minister. He had an able set of ministers in his group, the most notable being our Manmohan Singh. And the reform started, and from then on the markets went up. It did get punctured again because of the Harshad Mehta scam, when one broker called Harshad Mehta circulated forged share certificates in the markets, which came to be known at a much later time. People lost confidence. They did not know whether they were holding the real certificate or the forged certificate. The markets crashed. That is when the dematerialization of share certificates came into being. 1994-95, markets went up again. 1999, there was a dot-com bubble burst. Markets came down. There was a recovery again. 2001, we know what happened in USA, the 9/11. Markets came down, but they quickly recovered. From 2004 to 2007, there was a dream run. The equity markets had a dream run. Again, 2008 was the financial crisis. There was a recovery in 2010. 2014 to 2019, 2019 to 2020, markets all had a dream run. So look at that. The Sensex in 1979, that is April 1st, 1979, the Sensex was 100 points. It touched an all-time high on 20th January 2020. It went up all the way to 42,000 odd, 273. Over a period of 41 years, from 1979 to 2020, over a 41-year period, the markets went up by 423 times, which means that if you had invested 1,000 rupees in Sensex, forget the stock. If you had invested the money in the index itself, if you had bought Sensex in 1979 for 1,000 rupees, you would be worth 1,000 into 423, 4,23,000. Just 1,000 rupees sum would have multiplied. So imagine 10,000 or imagine 20,000 or the multiples. You will know. Similarly, the Nifty, which came later, the broad-based Nifty came after all the fiasco that happened in the markets, another new exchange was built, the National Stock Exchange, the broad-based Nifty that came in the year 1996 with 100 points. I say broad-based because they took 50 stocks and the base was 100. It went up all the way to 12,400. In a matter of 24 years, we could make 125, 24 times more. That's Nifty for you. So, what are we talking about when we say market risk? What is market risk here? If you have invested over a long period of time, where is the market risk? The market risk comes only when you want to put money today and take it back yesterday. That is what all of us think, right? I want to become a millionaire overnight. That can never happen. Don't even think about it. The only way it can happen is through a lottery. If you bet on a London lottery, probably that will give you 90 crores if you make money. If you bet on any lottery anyway, maybe that can happen, but you know what the probability is. The probability is less than 1. Any probability is always less than 1. The probability is very, very low. 0.0000000. You add as many zeros as you want and then put 1 there. No way. So the best way to make money is to stay invested in the markets. I will show you what has happened with some of the investments that started early. The most popular one is Reliance Industries. Everybody knows about Reliance Industries. Dhirubhai Ambani's Reliance Industries came to the markets with an IPO in 1977. Very low priced. I didn't know about Reliance Industries until I came to work in DB Jain College in the year 1979, and I'm really ashamed to tell you that this business of stock market investing was introduced to me not by any of the people in the finance department or commerce department. It was introduced to me by two lecturers, one from the Telugu department, Mr. Seshagiri Rao, and another from the English department, Mr. B. Radhakrishnamurthy. These were the people trading in stock markets, and they used to sit there and talk about earning per share. They used to talk about price earning multiple. It was such a shameful experience because we didn't even know about this at that age. Because I was also fairly young. My interest was elsewhere. I didn't know anything about stock markets at that point in time. But these people used to sit and talk there. Anybody who invested 1,000 rupees in this company in that period, that is 1977, they would be worth, as you can see there, they would be worth so much today. 1.2 crores. In 2008, when Reliance Industries acquired an oil company, IPCL, Dhirubhai Ambani was not there, Mukesh was there. Mukesh said, I am proud to say that anybody who invested 1,000 rupees in Reliance Industries in 1977 is worth 10 lakhs in face value